What's going on, everybody? This is Jeff with Altcoin Buzz. So I'm going to make a video here to talk about the bubble. The one that everyone's kind of like, Jeff, are we in a bubble? What do you think about the bubble? When will it pop? Could the bubble pop? And because I don't know the exact date of when that will happen or if it will happen, the only thing that I can say is there will be signals that basically a bubble is getting ready to pop. And what I'm looking to do with this video is not give you an anticipated date of when and where or whatever. It's here are the signals to look out for, and not just my signals, but the historical data or the historicals of what bubbles have typically looked like from my own experience and from what economists have said in the past. There's one that I really took heed to, and I'm going to go to it first before I get into any of my own personal opinion. Okay, so here on Investopedia.com, so you can see it says the 5 steps of a bubble. They kind of go through it, but there was one theory on here. It's called Minsky's theory of financial instability, the 5 steps of a bubble. Minsky identified 5 stages in a typical credit cycle: displacement, boom, euphoria, profit-taking, and panic. Although there are various interpretations of the cycle, the general pattern of bubble activity remains fairly consistent. So, displacement. A displacement occurs when investors get enamored by a new paradigm. You've heard that term used. We're in a new paradigm. John McAfee even said that about a month ago. Such as an innovative new technology or interest that are historically low. Okay, so cryptocurrency, right? Undervalued, room to grow would be what we would say about that, though. A classic example of displacement is the decline in the federal funds rate from 6.5% in May 2000 to 1% in June 2003. Over this 3-year period, the interest rate on 30-year fixed mortgages fell by 2.5 percentage points into a historic low of 5.21%, sowing the seeds for the housing bubble. If you flash back to 2007, you'll remember the housing bubble that occurred back then in the housing market, where there was a lot of people who were getting in over their heads because they had loosened the laws on who could invest in a house, and it didn't really matter what their income was because of the Equal Housing Lending Act, essentially, which was put into place in the 90s, where basically they could not discriminate based on various factors, including income. So they loosened the law on that, and people were getting pre-qualified and qualified for houses. And then what ended up happening, prices went up because more and more people were able to buy houses. And then it reached a pinnacle where people were losing their jobs, and then they defaulted on the loans, and then boom, the bubble popped, right? So the housing market and cryptocurrency market are 2 totally different paradigms in and of themselves. But let's move on to the second thing. Boom, prices slowly at first, or rise slowly at first following a displacement, but then gain momentum as more and more participants enter the market. That's the slow, less than 1%. The herd is coming. It goes to 10% of the population, 30% of the population, and then who knows where we'll be, but 50% to 100% of the population if we ever get there, right? So that's kind of right now, I would say it's still slow at first, considering that the cryptocurrency market overall has a $783 billion valuation, which is less than Microsoft, Apple, Google. If you take both Google stocks, because there's 2 stocks, there's GOOGL and GOOG. They're both about, I want to say, $750 billion last time I checked. So that puts them at about $1.5 trillion market cap for Google. But, we're not even at that valuation as a whole entire market. So I would say, based on the signals that are there right now, we don't appear to be in a bubble, okay? Based on the fact that we're not even, the whole entire cryptocurrency market isn't even valued as much as one company like Apple or Google or Microsoft right now. So I think as this continues to soar past $1 trillion and it starts to pass some of the top companies, and it maybe goes to $2 trillion, depending on how fast we get there and how much things, how many things we're having to take a look at. You know, as we start to penetrate into the trillions of dollars, that's when things might start to be really bubbly, so to speak. But being that the whole market doesn't even have a valuation of one of some of the top companies in America or in the world, then I would say it doesn't appear as though we're reaching the peak of the bubble. But what do I know, right? I'm just a layman, really, an analyst, a layman analyst, you know. And even if we were to tune into CNBC or Bloomberg or any of the major channels, they'll have analysts on there that might not necessarily know the answers either, because no one can really project or predict these kind of things. We can just maybe there's some people who know, but by and large, the general masses won't know about it. All right, so that's the boom. Euphoria. We do have this sense of euphoria taking place. So during this phase, caution is thrown to the wind as asset prices skyrocket. So as the news continues to become more and more excited about Bitcoin and cryptocurrencies, that's the euphoria. People start to say, oh, this thing's really taken off and I don't see an end in sight. So when the euphoria stage kicks in and people start scoffing off the idea of a bubble forming, that's the euphoria. The greater fool theory plays out everywhere. Valuations reach extreme levels during this phase. For example, the peak of the Japanese real estate bubble in 1989. Land in Tokyo sold for as much as $139,000 per square foot, or more than 350 times the value of Manhattan. After the bubble burst, the real estate lost approximately 80% of its inflated value. So to those people who say that Bitcoin is way overvalued and at some point the Bitcoin bubble will pop, it wouldn't be, let's say Bitcoin went to $100,000, it could pull all the way back down to who knows where, right? 80% would be 20,000 if you were using that exact math. But that's where they're kind of getting that idea, because historically they've seen it even with the Tokyo housing collapse. Okay, during the euphoric phase, new valuation measures and metrics are touted to justify the relentless rise in asset prices. Profit taking. By this time, the smart money, heeding the warning signs, is generally selling out of positions and taking profit. But estimating the exact time when a bubble is due to collapse can be a difficult exercise and extremely hazardous ones to one's financial health, because as John Maynard Keynes, he's from Keynesian economics. If you're looking for a book to read on economics, you can look up John Maynard Keynes and check out Keynesian economics. There's also another one by Milton Friedman. But the markets can stay irrational longer than you can stay solvent. Note that it only takes a relatively minor event to prick a bubble, but once it's pricked, the bubble cannot inflate again. It's like a bubble gum. If you blow your bubble gum and you poke it, it'll deflate, right? And that's the same kind of thing as what they're saying right here. So in August 2007, for example, French bank BNP Paribas halted withdrawals from 3 investment funds with substantial exposure to the U.S. subprime market mortgages because it could not value their holdings. Okay, so this rattled the financial markets. It was brushed aside over the next couple of months as global equity markets reached new highs. In retrospect, this relatively minor event was indeed a warning sign of the turbulent times to come. So where have we seen that in this market today? We've seen that with Russia banning cryptocurrency. We've seen it with China banning cryptocurrency exchanges and ICOs. So if you've been in the market since at least September, you would have known about the China FUD, as it was famously called, China FUD. And Bitcoin took a nice hit and rebounded about 2 weeks later. Okay, so during that time, there was some panic, which created a buying opportunity. So that's where you have to be careful in identifying the buying opportunities. It's one thing to have a holiday hit and know that a holiday is going to bring along with it, but like Christmas holiday and New Year's holiday, you could almost anticipate that the market was going to calm down and maybe some money was going to come out because it was the holiday. Typically, the bubble doesn't pop around holidays. That's just a time where it kind of stagnates and there's a buying opportunity, which we had this last go around, right? But if it were to happen in something like, I don't know, October or I don't know, April of some time, you would see that, that could be the beginning of a larger issue. So if you were to, like, let's just say that the United States rolled out some very aggressive sanctions or guidelines saying that cryptocurrency was illegal, blah blah blah, or that banks said that you could no longer convert fiat into cryptocurrency, something like that. That would be a cause for concern potentially. And that would lead to the panic. In the panic stage, asset prices reverse course and descend as rapidly as they had ascended. So a bunch of people will be pulling money out as fast as possible because the ones who are looking for the signals got the signals that they needed to pull money out. Now, in making this video, my goal is not to FUD you out of the market at all. It's to prepare you for the signals, to be on the lookout for the signals when and if they become present at any point, okay? And that's the whole point of this video. It's not to scare you or anything like that. So, anatomy of a stock bubble. Numerous internet-related companies made their public debut in spectacular fashion in the late 90s, before disappearing into oblivion by 2002. We use the example of eToys to illustrate how a stock bubble typically plays out. So, in May 1999, with the internet revolution in full swing, eToys had a very successful initial public offering. Sound like some of these initial coin offerings you're hearing about, right? Where shares at $20 each escalated to $78 on their first day of trading. The company was less than 3 years old at the point and had grown sales to $30 million for the end of March 31, 1999, from $0.7 million to the preceding year. Investors were very enthusiastic about the stock's prospects, and with the general thinking being that most toy buyers would buy toys online rather than at retail stores such as Toys R Us. Well, that ended up being true because Amazon now gets those. This was displacement phase of the bubble. Okay, so at the end of the day, with this article, it's a very interesting article. If you want to reference it, it's on Investopedia, and I thought they did a great job of outlining that. Now, some of the things that I'm going to be looking for in terms of the warning signs about the bubble, that I'm not going to turn off my radar beacons on that. That's like saying, like, you're in, I'm not going to use a military analogy because I think I overdo that, but you'll know when you're in hostile territory, okay? So it's basically like saying you're not just going to forget that if you're the Patriots, say, and you're running downfield, you're not going to forget about Troy Polamalu. This is back in, 2008 probably, when Troy was awesome. But Tom probably didn't forget about Troy Polamalu coming from his blind side ready to knock him down, right? He didn't want it to happen, of course. And, he would have hoped that Fred Taylor was there to block. But if Polamalu was coming up the blind side, he could get checked. Tom could, right? Maybe even fumble. So it's all about having a contingency in place, and that's what we're talking about. So the contingency here, the contingency plan would be if the governments of the world started getting very bearish or very aggressive against cryptocurrencies. And I know that a lot of people remain hopeful that the governments can't intervene and that the banks will stay out of it. But you have to realize this. The banks, the central banks of the world, they use their power to go to war. If they use their power to go to war, why would they not also use their power to preserve their wealth? In the sense that they have wealth and they want to preserve it, and they also hold power to the military. Even if a decentralized global marketplace like cryptocurrency is taking place. So there has to be some sort of middle ground, whether anyone wants to admit it or not. You won't be able to have one without the other. The banks are going to have to evolve with cryptocurrency and blockchain and cryptocurrency are going to have to meet the banks halfway, because otherwise it's going to be a bloodbath on the streets. And I don't know what to say about that because I'm agnostic. All I'm saying is I like peace and a middle ground. I think that the system that we have right now can be improved upon. I think the fiat system, carrying around coins in our pockets and paper dollars, is really kind of just outdated and it needs modernization. And I think that cryptocurrency in itself could use a little bit more simplicity in getting things to be more hacker-proof, but also easier to use for the layman, right? Now, So if the United States were to do so, the United States rolls out cryptocurrency taxation on capital gains at a very high level. That's kind of a way of them saying, hey, we're going to let you play the game, but you're going to have to pay your taxes. Uh-huh. So that's kind of what they've done. Now, China is not letting their people participate, at least temporarily. But it'd be interesting to see if some of these world governments. So let's see how some of these world governments pan out in 2018. Do they become more friendly to cryptocurrency, or do they become more aggressive against it? If they become more aggressive against it, that's kind of when you are getting, when I would be getting the signal that the bubble could be forming, because that means that people will get scared out of the market. Based on what I've seen previously, when China banned cryptocurrency, the price did fall, and that came out of nowhere. So if the United States were to do that, or the EU or one of these other countries, it would have an impact on the market, and big money would come out of the market, and you might be left high and dry at an all-time high. So we'll see how that pans out, right? But that's a worst case scenario. I don't know anything else. But another thing that I would say is, if a lot of these companies that are collecting these initial coin offerings and getting a lot of your hard-earned cryptocurrency or hard-earned fiat that turned cryptocurrency aren't able to deliver on the work that they say they're going to, so they're just kind of existing. They say they're going to do something, but they're not really trying to put out anything substantial. That would be another signal. If that continues for too long, that would be another signal that this thing's kind of in a bubble, as if these projects don't prove to be anything of value. So we're going to have to hold these companies accountable for what they say they're going to do, instead of them saying that, oh yeah, we're doing this. Like, you're going to need Power Ledger and Golem to pull off their decentralized networks respectively. Golem's a supercomputer, Power Ledger's a decentralized power utility. So, we'll need these guys to do that. There's also going to be micro bubbles inside of the market. Not every one of these cryptocurrencies is going to be the lead privacy coin forever. Not every one of these is going to be the social media coin. Right now, you have Red Coin and Kin, which are neck and neck right here, but maybe they'll be the only two that pull out, or maybe it'll be Verge, or maybe they'll say, the U.S. government will say, anyone doing business with privacy coins is essentially in violation of the law, blah, blah, blah. And then the next thing you know, that anyone using Verge is in violation of the law, and a mass sell-off happens of privacy coins. That's a hypothetical that could happen in the privacy coin with a privacy coin bubble. If people have to sell their privacy coins and go into Bitcoin, that's probably what they would do. They would sell their privacy and go into Bitcoin, and Bitcoin would rise and privacy coins would pull back. But these are just hypothetical or ideas of things that you can be on the lookout that could potentially come up, and they're not too far-fetched. Obviously, we hope none of this happens, because we like to sleep at night and sleep in peace, but we'll see. So these are just some things to keep an eye on. I mean, there's a lot more to it. A bubble forming is a really deep tunnel to dig in. I mean, it's just when you think you've identified all the causes that could lead to a potential bubble, here comes the next thing that you didn't even anticipate that shows up, and then you're stuck with the choice. Well, do I take my profits now, or do I wait to see if this thing stabilizes? And if it never stabilizes, then you really lose out on a lot of the profits you thought you had, right? So just keep an eye out on this, guys. And I'm still very bullish on cryptocurrency. We still have less than 1% mainstream adoption of cryptocurrency, so the herd still hasn't shown up. The big thing would be dependent. A lot of it's going to, whether you guys like to admit it or not, the big thing is going to depend on how the U.S. government handles cryptocurrency. If they roll out some big law that is unfavorable to cryptocurrency, that's when things could get real hairy with us. Now, that just means that it doesn't mean that it would be done, that cryptocurrency would be done, because you'd still have Hong Kong and Singapore and British Virgin Islands and all these islands still kind of functioning as currency hubs outside of it all. Maybe Japan or Europe would have some safe havens too, but it would definitely take a hit. it would definitely take a hit. And if that happens, you're going to be stuck with the choice: do I ride it out and hold, or do you take your profit and jam out as is? And if a lot of people flood it out of the market in that case, it could potentially lead to at least a temporary halt of growth. That 20 to 30 years from now, cryptocurrency appears to be the only viable solution that we have. But it doesn't mean that there won't be bubbles in between. It's like saying there was a bubble in the U.S. economy in 2007, but we're out of the recession. So sometimes in that case, that's a long hold for you. Anyways, guys, this is Jeff with Altcoin Buzz. We've been putting out a lot of information on Twitter here. I've got a new channel for you guys to follow. Your Altcoins, he's pretty cool. I'm going to follow this guy. And let's go ahead and check our channel real quick. Altcoin Buzz IO. So you can follow us right here. And you can also follow us on Instagram. 16.7. Let's see where we're at now. 16.8. So we just keep going up, up, up. Now we're at 36,000.3. We started the day at 34. So I've also put out this notification thing here. Some of you guys are saying you're not getting notified. Get notified when we post. See diagram below to get notifications. For Twitter, to get notifications, you go to this little bell. Because I'm already following the page, or it's admin, you won't see it here. But on a mobile app, you would just go to this little bell and then hit this right here where it says all tweets. If you want to get notified when we drop the coins of the week, coins of the whatever we're doing at that specific time. You can also do the same thing on Instagram. You have to go to that little, there's three little dots, these three little dots right here. You have to click on that and hit turn on post notifications. And that's on Instagram. If you want to get notified, same with the coin of the week. So we'll see you guys later.